I'd like to see everyone. I'm just trying to get so I can see everybody. Everyone, thank you for coming to the talk. I appreciate it. I hope you will learn something. We're just trying to see it so I can see all your wonderful faces. Karen, whole group here. All right. All right, so what we're gonna do, I'm gonna try to make this as informative and fun as possible. Hope some of you have been to my talks before, and good. I'm gonna just usually do it. It's like the Harvard Club is happening for many years. I like to have a, a lot of us went to Harvard. We like to be active and engaged. So it's professorial style with my students in the class answering questions. So we're now, in the Zoom world. So we're gonna try to make it more interactive. But I've never done it through Zoom, so please bear with me. But I have a lot of body of knowledge I want to get across to you. It's called Understanding the World, which is now a small feat in an hour, plus your portfolio, which is another not a very small feat in an hour. Plus, you're going to learn a little bit about me and what drives me to be passionate about this subject. So we're going to move down. So disclosure, everything I say is just my view. I'm Marisa Joelson. My given name is Marisa, which is Spanish for laughter, but I go by Maya, and MetaPoint Advisors, which is the firm that I founded. So all of my thoughts, I might be associated with other firms, but these are just the representations of me and my firm. I can be a bit contrarian, have a lot of, like a lot of Harvard people, independent ideas, which is, I think, one of the things which drives me. It drives my family, which I'll talk to you about, as far as not always adhering to groupthink, thinking independently, and being. And so these are my ideas, not anyone else. The agenda, we're going to go put forward the investment Jeopardy guidelines, Mojo, my initials. Phelan's my middle name, Mojo. Give some background, what motivates me to care about the world. Then I'm going to go over some of the investment conventional wisdom, which is what everyone in finance will be generally would tell you. So there are plenty of people that have told you these things before. So I'm going to talk to you about why I think some of those theories might be no longer valid or never valid in the first place. The evolution of the U.S. financial markets and retirement planning. We all care about our financial futures. So I'm going to go over the U.S. because one, that we're here, and that's where what's the rules we need to live by. And two, it's the most dominant market. And so basically things start in the U.S. as far as structures, mutual funds, ETFs, structured notes, whatever, and then they get exported globally. So we need to understand what's happening in the U.S. And then we're going to go global pictures. How do those the issues in the U.S. plus globally, how do we want to invest in this world, right? Well, let's understand, one, what's happening in the world. Two, if you're saying emerging markets, does the investment vehicle that you're investing in, does it actually invest in emerging markets or not? Should you be investing in emerging markets, or should you invest in the U.S.? So to try to go over all these issues to help you think through those decisions, which is essentially your money and your financial future. And then key takeaways. So in order, Mojo Investment Jeopardy setup. So to participate, you need to have your video on and your full name listed. Answers are to be quick, like in Jeopardy, not soliloquies. I know we at Harvard people can write books on a lot of these topics. The unmute button is your clicker. Unmute it to answer, and mute once you've given your answer. If it's too unwieldy, we might have to winnow it down. And the final Jeopardy bonus question is, can you answer this riddle? How can Maya say that she slept in Einstein's bed? So I don't usually kiss and tell, but this, it has to be a living person that has slept in Einstein's bed, and a living woman. I know a few men, and you'll figure out why later, but no women that I know of. So it's kind of a cool fact. So that is the bonus questions. All right, so who's up for Investment Jeopardy? Who are my contestants? I see Norman, you're there. Who else is here? Diane, Chris. Are these my contestants? All right, sounds good. Anyone else? All right, good. Just like Jeopardy, I got my 3 contestants. And Rachel's my friend here, so she's helping out. So we won't let her answer because she might cheat. But anyway, so great. Diane, Norman, and Chris, let's roll. And everyone else listening. So let's do a brief history of the last century. This is driven by, we'll talk about my grandfather and why I care so much. Basically, my grandfather was born in Latvia in 1915. This is the first question for Jeopardy. In 1915, he went to Petrograd. What is another word for name for Petrograd? Norman, are you unmuted?
St. Petersburg.
Yes, St. Petersburg. Great. At that point known as Leningrad, on to St. Petersburg. So he was there in 1915. In 1917, he went to university as what is known as the Harvard of Russia. What would that be called? Anyone? Contestants? None. Okay.
Moscow State University.
Yes, Norman, you get 200 points for you. You went to Moscow. You took a phone out though. You were in here, someone's coming in. So Moscow State University, and it was 1917. What was happening in Russia in 1917?
Revolution.
Yes, Norman for 300. Communist revolution. So my grandfather said, did he want to stick around like most people? He said, no. He said, I don't want to be part of the communism. I don't want to be part of, the Iron Wall. And so he left to Germany and he got his engineering degree. And then he went to, so we're pushing this down. Okay, admit some people are coming in. I'm trying to push this down. Sorry. Technical fail. Do you have the magic touch? There. So this is my grandfather. This is up here. So he went to Germany. He went to Germany, but then he was actually from France first. This is him. He was helping on the World Fair as a plumbing fitter. Then he was in the Seine and he spotted my grandmother from Austria. She seems to like tall women. So he found her and married her and had my father in 1934. And so then in 19-something, the Munich Pact was signed. What year was the Munich Pact signed? Okay, well, so in 1938, the Munich Pact signed. And so he said this was where the UK and France and other powers agreed to have Germany access Czechoslovakia and other lands. And he said he was ready, he wanted to get out. So luckily he made plans for my family and my father to get out. And they are out the last, when the troops were coming into France, when my grandfather was getting out of town, picking up my father in the countryside and my grandmother, going through U-boats and finally coming to Ellis Island. My grandfather went to become the CEO of this wood company. He had his pink Cadillac in Miami. And so one of the things I want to impress upon you is my grandfather didn't follow groupthink. And, he could have ended up in Auschwitz. He could have ended up behind the Iron Curtain, but he was able to make decisions to understand the world before other people, one, to pay attention, and two, to make decisions to get out. And that saved him, and my family, my father. And so, in my little way, in when I talk about investing too, it's about understanding the world before other people, and that can help you either, this was an extreme example for his livelihood, but also for your money. This is my father. My father actually, so when he arrived, he was 6 years old over here. My grandmother actually died right after. She had cancer. She couldn't be treated. This was the Jewish marked Jew. And so luckily there was a family my father became a Hoosier. So what state did he go to? Indiana, right. So thankfully there was a family, the Kahn family, and they took my father in for high school. And and so my father became a Hoosier as well as, so he loved opera and baseball, and went on to Harvard Law, and Oxford, and international antitrust lawyer, representing UK and Australia, amongst other things. So here's a picture of us. This is my father, big, imposing man. So I see Larry Summers. I say, reminds me of my dad, but my dad's bigger. This is my mom, no slouch herself. Her father was the first Irish person in his family to go to Villanova engineering, and was working for Exxon in the 50s to negotiating contracts, going all over the world. So she got the travel bug too, and she was one of the first women at Georgetown School of Affairs with Mr. Paul Pelosi, whose wife is Nancy Pelosi. Okay, and who else? What famous president graduated from Georgetown School of Affairs? Anyone? William Jefferson Clinton. There we go. So, and then Ruth Bader Ginsburg. This was at the 100th anniversary of the first Jewish Justice. Brandeis was also one of my father's friends, his grandson, and they were all friends in Harvard Law School. My father's Joelson sat next to Ginsburg. Marty Ginsburg were friendly. And I want to say that I was born, so what year? I was born in 1973. What happened that year in terms of women? So a lot of things, Roe versus Wade, Equal Rights Amendment. Ruth was working. Right. Ruth was working on knocking down the law so that companies can no longer say we're not going to hire women. Back in the day, companies, law firms didn't hire Jews. They don't tell you, it's not in the books, they just don't do it. So part of what's been my life path is I've been in finance and technology. And so, trying to build the way for women, because even though they're still not the same opportunities. So when I was at Harvard Kennedy School, my primary focus was international economics and finance, but I reached out to the World Economic Forum at Davos in 2003. I said, what are you doing around women? And they said nothing. That women weren't that important, or there was not money for it. I said, well, I think we're important. So I wrote the first business case for women, why companies should care. We're 50% of the labor force of society and 80% of purchasing decisions. So that launched essentially the whole World Economic Forum, and corporations focus on women diversity across other groups. There's a lot of lip service, but at least now there's data that says that diverse groups outperform. So there's the business case for it. We just need to get more action. Okay, moving on to investments. So I've worked over 2 decades at top in finance investment banking in both New York and London, later moving into financial advisory at Merrill Lynch. In the 90s, I worked in DARPA, which was right when the internet had just been invented, including with the founder of InSurf, advised a big mining firm, Rio Tinto, on macroeconomy, what was going on, as well as geopolitics, been featured in Wall Street Journal, Barron, and Forbes. So I got my MBA from Kellogg and then went to Harvard for international economics. So we went back, I told you the story about my grandfather, in part to say, look, it's important to think for yourself and not be too subject to groupthink, right? Because what would have happened had he followed the rest? And so I'm saying too, there is a lot of groupthink. There's a lot of conventional wisdom that isn't necessarily right in finance. So we're going to go and think about them and how challenging or thinking twice or about the groupthink might help you and your portfolio. So here are some conventional wisdom you've heard everywhere. Diversification leads to better returns. Random walk, you can't beat the stock market. Mean reversion, if stocks have been underperforming, you should buy them, they're cheap. If otherwise geographies, people say this, you can just hear them on CNBC and other things. They just say, well, it's cheap, you should buy it. It's undervalued, you should buy it. It's overvalued, you should sell it. Just this view of mean reversion and factor-based investing, where you value growth, things like that. So just some ways in which by not following the herd, I've been able to outperform for my clients. Is last February, I was the first that I know of that came and I said coronavirus, the black swan, which could trigger a crash. And that was back in February. My rationale was just China had become the second biggest country in the world. And if there was an issue in China, there was going to be an issue globally. It was going to affect many. Now, I got clients came back to me. They said, "Well, Goldman Sachs doesn't think it's a big issue." They were, speaking to SARS. I said, "Well, that was 15 years ago." So there was a lot of pushback, but then we saw what happened. There was a crash. So that's kind of, what I want to impress upon is just being able to connect dots, understand the world better can help you and your portfolio. Another thing is just to when people think about, my favorite thing about Donald Rumsfeld was him popularizing the phrase like known unknowns, known knowns, right? So even when I see there are looming risks, like my grandfather saw looming risks and a big downside, he took action to protect himself and his family. And so that's when I see looming risks and a big downside, just protect. So that was something too that I did at the beginning of September. In August, I said the US market, we had a lot of looming risks. We had the $300 jobless benefit. It was coming undone. We have now squabbling in Congress, particularly over taxes and a debt ceiling, which was huge. We had raging COVID that would come back with schools were coming back. So there were a lot of risks. Plus China had been cracking down and not many positives. And so that's why I protected my clients. And so something for you to think about is if you lose 50% of your money, right? How much percentage do you need to get back to where you started?
100%.
100, right? Yeah. So be wary when people talk, oh, well, if you missed 2009, say March 2009, the best days, you would have lost out of 50%. Well, if you had gone, peak to trough, if you had got sold out at the peak, and you hadn't sold out, it would take 7 years to get back your money. When it fell 50%, and it would take as well both the 2000 crash as well as 2007. It took over 5 to 7 years to get back your money. So that's a long time. That if you do see looming risk, that's why I say for my clients, let's take some money off the table or reposition or whatever so that we can save ourselves 7 years in the stock market. So here's been my outperformance as of last year. I got 41% for my clients who have over $1 million with me versus 16% for the average for the S&P, 17% index return. That's over 24% outperformance. And then also talk a little bit on the other side, basically bonds have such low yields, so you need to find, I try to get outperformance too in the non-equity portfolio. And this is just showing you that if you have 1 year of outperformance, that you can, instead of being at 3.5 million, you can be at 7 million just with 1 year, given the impact of compound interest. Okay, we're gonna now take a shift away from kind of the motivator, hopefully, that understanding, and I'm going through a lot, and the reason why hopefully you'll stick with me is that understanding these things might be able to help you understand the world better and help you make more money and save money on the downside. And so one of the things we need to do is understand the changes in investments in America. And so a key decade was the 1980s. Okay, who was the president in the 1980s? All right, guys, you know this one. Come on. Reagan, right? Good, thank you. Reagan. So there were a lot of shifts going on. Oh, sorry, let's go back up. Yeah, 1980s, a lot of shifts. So let's say back in 1980, how did we generally do retirement planning? Let's say it's typically a man and he had worked at a company for 40 years. So what happened when he retired? I heard it.
It's a
Great.
pension.
He got a pension, yes. So he would get a pension, let's
Regular
say
pension,
50,
yeah.
huh? So
Regular pension.
a regular pension, so that was called defined benefits. Let's say he would get $50,000 for the rest of his life, and then his widow would be taken care of too, and that was retirement planning. But what happened in the 1980s, one, people were switching jobs more, maybe women entering more. And then also you had Reagan, who cared about competitiveness of American companies. And if you have GM and they have all these, which are called liabilities, pensions they have to pay for, it's very hard for them to compete with Japan, Japanese companies, which don't have those liabilities. So let's take this responsibility and these liabilities off of the company. And so they created basically the 401k plan became much more popular in the 1980s, which was called defined contribution. So then let's say you were able to put in $5,000 of your own money, of your pre-tax dollars, and then the company would match it, right? Match programs say $5,000. So you now had $10,000 that you could invest in your retirement. Now, back then, let's say you want to buy a stock. In order to buy a stock, you had to buy a lot of stock. What does that mean, a lot of stock? Is there a number associated with it?
100 shares.
100, great, exactly. There's 100 shares. So if we think back to the movies, The Wall Street, the brokers are calling, hey, you want to buy Exxon? Yeah, you're in. It meant 100 shares. Now, let's say Exxon was $100 and you had to buy 100 shares. How much would you have to pay?
10,000.
10,000. And how much are you putting into your 401k? 10,000. So you're not very diversified now, are you? So therefore, we see the proliferation of the mutual fund. Who can name some mutual fund companies?
T. Rowe Price.
Yep.
Vanguard.
I don't know if I consider Vanguard, but well, we're getting to Vanguard.
Fidelity.
Let's say Fidelity. Yeah. Any others? This has multiple right answers. All right. So T. Rowe Price, American Funds. And so what their proposition was, we're going to hire the smartest guys out of business school, and we're going to have them analyze what are the best companies and, go decide whether you should buy Colgate or Clorox or Exxon or Ford and so basically then you buy a share in their diversified fund, and a portfolio manager who would decide which were the best companies to make a diversified fund, and you'd buy into that. And those are mutual funds and the proliferation of mutual funds. My favorite was Peter Lynch. Who knows Peter Lynch and what company he worked for or what fund he was running or what book he wrote? Anyone? All right, so it's a great one to check out. Peter Lynch was a star fund manager at Fidelity, running the Magellan Fund, and he wrote this book called One Up on Wall Street: How You Can Beat Wall Street, because you understand better of what's going on in the community, and so we'll talk about there. But so we have the proliferation of mutual funds, so we need to understand that. Because then they become global mutual funds, which is what I advised in London. I advised T. Rowe Price, JPMorgan, all in their global funds. Okay, I'm trying to move down. I just click it, maybe it'll work.
Yeah.
Okay, good. Now, what happened in the 1990s? So mutual funds were all the rage, but then somebody mentioned Vanguard, right? So they come along and they say, you know what? These active funds are underperforming after fees. Let's just create an ETF. Who knows what an ETF is? What's it stand for?
Exchange traded fund.
Exactly, exchange traded funds. So instead of professionals pouring through, analyzing companies, which are the best companies, instead they say, let's just do a rule Let's just buy the top 500 companies by market capitalization, the S&P. That's the most basic ETF, which we call an index fund. Now, let's talk about why the mutual funds were underperforming. So one of them was fees, right? All these guys, they have these great companies, they have these great jobs. And so, those things cost money, all those big fancy towers and the big cities and the big incomes. Now, what's the other thing? What is the number one goal of one of those analysts? What is our portfolio manager, an active fund manager? Here he's got this nice, what's his number one goal? Is it to beat the market? Or is it, that's what you would think it should be, to beat and outperform the market. But I would argue another big or huge issue, or a huge incentive was they had this nice cushy job in a nice cushy city, and they have their wife and their kids going to private school. Their number one goal, don't lose your job, right? So how do you not lose your job? Oh, I got a laugh out of Norman, good. So how do you not lose your job? You do what's called benchmark hugging. Who knows what that is? Benchmark hugging. So benchmark hugging, benchmark might be the S&P 500. So did Diane, you got an answer?
Meeting the S&P.
Yeah, beating the S&P, but that's, matching, right? Matching. To hug. So they'd hug the benchmark because you don't get fired if you're 5% or 5% below, but you do get fired if you're 10% below. So there's not much of an incentive. Your incentive is not to get fired. So that's one of the reasons I argue that mutual funds underperform, not necessarily because active management doesn't work, but because one, the incentives, one, there are very high fees. Two, the incentives, and also they selected the same people. They selected the same kind of people, not a diverse type of people. But anyway, the point is, in this point, in the 1990s, ETFs took over, and a random walk down Wall Street. What is that about? The time-tested strategy for successful investing. 1.5 million copies sold. What does he say? He says, don't even bother trying to outperform the market. It's just a random walk. So that too fuels, hey, why pay these expensive people to pay mutual funds if they can't perform anyway, and it's impossible. So there that is now. As I said, my talk is saying, let's sometimes think about and challenge conventional wisdom. Is conventional wisdom always right? This is what they're saying. This is still probably what you hear now. Warren Buffett is going around saying, just put money in the index. Is that how Warren Buffett made his money? How did Warren Buffett make his money? Investing and making calculated bets in stocks. So that's not how he made his money. So here's just an example. In 1990s, if you had put $10,000 into the S&P versus $10,000 into Apple, you can see the huge rise in Apple. And I would argue, is Apple a random stock? Is that just a random stock? I see portfolios. No, people understood the product. They believed in the vision of the company, and that's why they invested in it. It was an educated bet. It wasn't a random walk, right? It wasn't a dartboard. And so that difference, had you gone for conventional wisdom and put it into the S&P index, you would now have $70,000. All right, here we have. This is, you would have $70,000 had you put it in the market. Had you put it in Apple and made a strategic bet, you would have $2.2 million. So that's, and then we'll change the numbers. This was, I did a few, like 2020, let's say last year. So it's about a $2 million difference to actually pay attention to what you're investing in and invest in things that you believe in. And that's just for one stock for $10,000, right? So So therefore, I challenge this conventional wisdom that you can't beat the market. I say just because homogenous financial fund managers, and I say part of the thing, 98% of funds and assets are only 2% of assets are managed by women or minorities. 98% are homogenous financial fund managers. Meanwhile, women are 50% just of society, of labor, of the educated, and we make 80% of purchasing decisions. So maybe it's so to say that this particular group of unbalanced managers can't beat the market doesn't mean nobody can. And just I said there are other issues. Let's just say I always played soccer. I have a left foot. I can score with my left foot. Most people can't. But that doesn't mean, so if you look and say most people can't, that doesn't mean nobody can. You just have to find the people that, if you want to score on the left side, find someone who can score with their left foot. And so just saying even, it doesn't have to be rocket science. There are a lot of people I know who knew, that believed in Apple, and they were well rewarded with millions of dollars by making that choice. So here's another conventional wisdom that you might want to rethink. So this is Money Magazine, but you've seen it all over. This one chart can make you richer. This is in 2018. They wrote this, but it's over and over. Who's seen it? Raise your hand. Have you seen a chart like that? Looks like this. It's called the periodic table of investment returns. So yes, I know there's people raising. So what they say is this. In the 1990s, basically S&P growth, which we'll just call tech stocks did really well, but emerging markets and commodities did really poorly. However, in the 2000s, emerging markets and commodities did very well, and tech stocks did poorly. Therefore, what is their conclusion? Their conclusion is investment returns are unpredictable, and therefore diversification, you have to diversify. Basically invest 10% in everything, right? So that's the conventional wisdom. Now let's go. Investment returns are unpredictable. But we're economists, we understand supply and demand. If you understand the world, you can have an understanding of the world. So let's go back. What was actually happening, let's say in the 1990s, that why tech companies did so well and commodities firms did poorly, and why in the 2000 emerging markets and commodities did well, but tech did poorly. So we go here. So here we are in the 1990s. The first thing you need to know about the US market and the world market is there was a very high correlation between oil prices and recessions. So there was a spike in oil in 1991. What do you think the cause of that was? Where did George Bush, where did we go into? Where did we invade or protect our allies?
Oh, it's a Gulf War. It's the first Gulf War.
What?
It's a Gulf War, the first Gulf War.
Exactly. So oil prices spiked. That caused a recession. Then another huge issue. What was happening? What was happening in the 90s with respect to the world? We have the end of the Cold War, right? So Russia opens up. Russia and all its oil starts flooding the market. This is me in Russia. Me in Russia. I was there in 1993, 94. I was interested in the world, communism, capitalism, and where else is more interesting than Russia in that time period. So I was there on the ground. And the other thing, going back to knowing one up on Wall Street, you can beat the Wall Street. I was with my mother's investment club, and there was this lady, and she said, she said, there is this company. We were at Arlington, Virginia. She said, there is this company, and they keep giving me all this business, and their name is AOL. Okay, so what do you guys associate with AOL? Can anyone make the sound of the dial-up? Okay, you've got mail. Anyone got mail? Anyone heard you got mail before? All right, you got mail. So basically, we had the internet, the start of the huge technological revolution that we're still in, happening in 1992, right? So that's why commodities did poorly, because there's a flood of commodities, supply and demand, too much supply. And meanwhile, so low commodities, meanwhile, a proliferation in tech, because we had we had the internet and you know, the first revolution of the internet. Over here, you can see a picture of me and Vince Cerf. He is one of the founders of the internet. Who is the other founder? Anyone know? Tim Berners-Lee. And they were funded by the Defense Department, a special group, the Research and Development Group known as
DARPA.
DARPA, exactly. So DARPA, some people, Al Gore takes credit. He did make sure DARPA got funding, but it was these fellows, Vince Cerf and Tim Berners-Lee, that came up with TCP/IP protocol and the World Wide Web. And so then when I graduated college, I wanted to be part of this technology revolution. And so I got a job working for DARPA and thinking about all the advanced technologies like artificial intelligence, collaborative technologies. So the program, I was actually on the same project as Vince Cerf. It was the lead visionary was John Poindexter, who was formerly a what in the Navy?
Admiral.
Admiral, great. He was, we got a little trouble in the 80s. We won't talk about that right now, but he was a very smart man. And he said in 1996, when we were working on this, the CIA is not sharing information with the FBI, is not sharing with the National Security Council. And so we would think about how can we get collaborative technologies to help these agencies share information. So if you think about now, you know, Zoom and Slack and all these companies are all around how do we share information, how do we get people to work together. So we were working back then, as well as artificial intelligence, you know, how do you natural language processing, all those things. So that's why, going back, that's why technology did so well in the 90s generally until the bust, and that's valuation went out of hand. And so that's what I'm saying. I believe in, I'm what you call a GARP investor. Does anyone know what GARP stands for? Growth at a reasonable price. So I believe in investing in growth stocks. Right now, there's a lot of talk around Cathie Wood and ARK. Do you all know ARK? So I would argue she wants innovation, but she is not GARP. She buys at unreasonable prices. And that was also fueled, I believe, by the Robinhood and the fact that last year people got $300 extra in their pocket, and they might understand that they like new technologies, but they don't know how to value a company. And that created a bubble, just like there was a bubble in the 2000s of you know, investing in companies that weren't sustainable. But we know there were companies like Amazon, Apple, Cisco, all that were very sustainable, that were long-term winners. So there we are, the 1990s. And so this is the US markets, just saying things had changed. This is where I'm going to move forward. So let's go back to that chart, which said you need to be diversified, right? And so my argument, if you go back here and you buy 10% of Russell 2000, 10% of this, 10% of S&P growth, I say you are actually over diversified. You're investing in everything. And if you invest in everything, you have no strategy. And you can figure out, if you analyze the world and understand the world, you can make educated bets on about which particular industries, sectors, geographies you want to invest in. So I say most portfolios that when I see people's, what they're invested in, they're over diversified. They have expensive black holes, which are the mutual funds. Most people have no idea what's in those. They have a name and they have no idea what they own. Or they're cheap black holes, which are ETFs. So we'll think about, well, Presage, what we're talking about later is emerging markets. If you're invested in emerging market ETF, what countries do you think you're invested in? So when I was in, do you guys know the term BRICS? The BRICS, what the BRIC countries are? Brazil, Russia, India, and China. So when I was working in emerging market in London, that's the countries we cared about. All of a sudden, the benchmark company that creates a benchmark is called MSCI, formerly Morgan Stanley. They're the ones that create the benchmarks. And they are the ones, they completely just changed the benchmark and the countries represented in the emerging market index. That no longer was it the BRIC countries, Brazil, Russia, India, China, but it was basically all of China, and there's Chinese tech stocks like Alibaba, Tencent. Those are the biggest holdings, and they had a higher weighting than all of India. So a lot of people, I think the problem with mutual funds is one, you're over diversified, and two, people often don't know what they own. It's better, I believe, to construct strategic portfolios and to make educated bets. And so let's move on. So here's going to what my approach is. I said what a lot I don't like. I look at the meta. What's the macro global issue? What's the base case? What's the scenarios? What ifs? I connect dots across geographies and issues. Like I said, what's going on in the US in the 1990s is the technology revolution. What's going on in the world is Russia and the fall of the wall and the flooding of resources, emerging market debt, things like that. Then look at the country. It's a red flag if somebody refers to international markets because they clearly don't have any understanding of the difference, because India is completely different than Japan, is completely different from Australia, is completely different than Germany, and it does not make sense to lump them together. To say whether you should invest in one or not, you need to understand the countries and what's going on there and what their economics are driven by, and emerging. So for instance, oil. Russia is an emerging company, it's an oil exporter. If oil goes up, they're doing great. India is an oil importer. So if oil goes up, it's doing poorly. So even within emerging, you need to know what the country is and what its economic dynamics are. Right now, we are having an energy crisis, a natural gas crisis, which Russia has a lot of natural gas. China needs it and is taking a lot of that natural gas. And so then Europe is having issues because they don't have enough natural gas. So you need to understand each country and what the dynamics are. That's what I do when I decide how to invest. And then you look at the sectors. What's going on in the sectors? As I said, technology versus energy versus industrials. What are the economic drivers? And then within that, so let's say, semiconductors are huge. There's huge growth area with the growth of autonomous vehicles, things like that. Okay, we love semiconductors, huge demand, but then look at the stock. Okay, NVIDIA has huge, great technology, Micron, you have to understand the stocks, the sectors in order to make strategic bets. And that's what I do and what's the approach that I advocate. And so this gives you an idea of a model portfolio I had in 2017. So some people say, well, I don't believe in diversification. I do, but statistics show if you have 30 stocks, you're diversified. Okay, I have more than 30 stocks, I have about 74. But so instead of, if you're in an ETF, you're at 500 stocks. That's too many. We can easily say, let's get rid of JCPenney. We don't invest in JCPenney. And that's also part of the financial revolution. When we go back and we talk about the 1980s, where you had to buy a lot of stocks, right? A lot, you had to buy 100. Well, now we have the benefit that you can buy one stock. You can buy a share of stock. So we can be more strategic in buying the actual stocks that we like, and we don't have to use on what I would say are old financial instruments of mutual funds and even ETFs. So here's just a model portfolio, that I completely outperformed. This is the stocks I had. I would buy VMware, Alarm.com, something like Roku would just drive my results. Just one or two stocks that if you make it right, just that Apple example, just a few stocks can drive huge outperformance. And on the as far as tax tax loss harvesting, the few losers that you have, you can offset your capital gains bill. So you also win by having a lower tax bill, because while, you know, the goal is to have as many as winners as possible, nobody can know everything. And so you can offset that with your losers. So you can get better performance by eliminating the bad companies, and better tax by being able to sell your losers. So here, you know, about 7% above in 2019. And that was not including the fact that I sold VMware. Basically, I changed it. Had we just taken the stocks I chose in 2017, you'd be up by 10% that year. And you'd be up by, in a bad year, up a little bit, well, you know, not better than the market, and 7%. And that's even before, but I actively managed throughout. And so, but that's just saying, had you been strategic about your stock selection in 2017, along the lines of what I did. And so here, showing you diversification, 36% cyclical, 17% consumer cyclical, you know, 13% financial services. I didn't like energy. I was underweight energy because this was the 2000s. 2010s, and basically the U.S. became much more energy independent with the advent of fracking in the early 2010s, and that's why I've been underweight energy. And I said at the first Harvard Club event I did in 2015, I said stay out of energy because of less demand from China, and because of the more supply from the frackers. And had you just done that, you'd be up 6% on the S&P. But you'll see it's diversified. It's just strategic. It tries to make bets around, you know, we can think of a number of different things that are going to do well. As I said, semiconductors, home building, you know, there's a number of sectors that you can think of that create a diversified whole. So here you'll see I overweight US markets. I know all about the other countries, but basically I think the US markets, as I said, one, the resource issues are a problem. Another real driver in the US is the fact that we're in a huge technology revolution, and the US is leading the way. We're at almost 25-30% of the index is technology companies, which are dominating the world. And so you might say, oh, let's invest in Europe. Europe doesn't have any technology companies. So, you know, so that's why I'm overweight the US. But then the other thing, as I said, is knowing what you own. Instead of having a black hole of a mutual fund with one name, you know what you own. So for me, here I am hugging the benchmark. I say Apple, Amazon, the Facebook. I don't like Jeff Bezos, but I don't want to bet against Jeff Bezos either. So that's why I hug around him. I hug around the big players. That I think are just their stalwarts. But something like Blackstone was overweight. But let's say when COVID came around, I said, let's get out of Blackstone. Blackstone owns the Cosmopolitan. It owns a bunch of commercial real estate. So I could be strategic about what I was going to sell, understanding what was the phenomenon that we were going to be dealing with. Whereas a Home Depot has done extremely well, given everyone's upgrading their homes. And so that's what I'm saying, there's power too, like in people say, oh, the market's going to go down. So let's say in September, August, I knew it was going to go down. And I said, yeah, but do I want to sell out of Apple and buy into Apple 2 months later? No, I'm just going to wait it out. Whereas other companies, I might say, you know what, that's not a long-term hold. It might not do well, let's get out of it. So we can be strategic. And just showing you here that as far as risk reward, this is return of this benchmark, say at least 6% over, and standard deviation. The risk metrics are the same as the S&P benchmark, or very similar, right? So you're not taking on more risk for a much better return. That's the goal, that's my goal. And then you'll see there's a 74 stocks. So diversified, but not over diversified. So going back to the conventional wisdom, that's what other people just say, oh, mean reversion. If European, if it's undervalued, it must go up. Whereas if it's high, it must go down. I challenge that. I say mean reversion is a term financial experts use to sound smart when they are not taking the time to more deeply understand the economic and business dynamics driving the stock industry or geography. There's little evidence that mean reversion works. We can see that Apple has not mean reverted down. Many companies have gone bankrupt, but they're not in studies because of survivorship bias. So instead of random walk, darts, instead of mean reversion, I have a new metaphor to how to think about investing in stocks, and I call it a student stock metaphor, okay? So if you're in the 3rd grade with Steve Jobs, Mark Zuckerberg, Bill Gates, and they get A's in every class from math to English to science, do you think they're gonna get A's the following year? Yes. But do you think Johnny C, he gets C's, is he gonna get an A the following year? Will he even get a B? Right, so that's what I say about stocks. Stocks are companies. If they have the top people at the top, you know, Jeff Bezos or whoever, they hire the best people. They hire the best lobbyists that get the tax rates the best for them. It's economies of scale. They attract all the great talent and they get better and better and better. Why should an underperforming company is not attracting all those great people, is having a hard time moving forward in leadership? So why should that stock mean revert? I disagree. I say go with the winners. And so going back to factor-based, so some people try to invest, they say, oh, it's about small cap and value. And even these Nobel Prize winning economists named Fama and French, they say, well, we're not the smartest, but we're gonna go with them because they're Nobel Prize winners. Well, then I say, well, their work was completed in 1993. Let's go back. What happened in 1993? We barely had the internet. Right? AOL was just on the scene. Netscape hadn't even been on this, hadn't been invented. So let's look at outdated economists and not be slaves to outdated information. Just treasury rates were huge back then, and now they're very low. So it's tons of things have changed, and you have to go with you don't be a slave to economic data, no matter how prestigious it sounds, if it's Nobel Prize winning, if it was done a long time ago. So here you see value versus growth. As we said, a lot of people, oh, value is going to come back because it's going to mean revert. Has that happened since 2012? If you had 2012, if you had invested in growth, you'd be up 375%. As I said, understanding we're in a technological revolution, and those companies are generating 30% to 120% in revenue growth. Okay, let's overweight growth stocks. Whereas this is the general level, but those people that stick, oh, value is going to mean revert, they only made 177%, half of what the growth, because they keep saying they're going to come back. And then I said, as far as understanding geographies, I said I focus on the US because of that generation of internet, of the technology. Also, let's look at Europe. I spent time in Europe and London. I work for Rio Tinto as a macroeconomist. And I looked at scenarios and what were some issues. And one issue was the Europe and the structure of Europe. There are simply too many countries in the new Europe, right? It's at least 27. So just imagine you had the US combined with Mexico, combined with Canada. Well, how would that look? How would that work? Anyone? That'd be very difficult, right, to get it to work. So that's what you have going on in Europe. You have 27 countries with very different languages, different GDP per capita, different interest clubs. So it's very hard for them to do anything, even harder for what we're getting happening in the US. And on top of that, they did not capitalize their banks properly after the 2008 crisis, as American companies did. So their banks are weighed down. And finally, they don't have the tech engine that we do. So for those reasons, I've stayed focused on the US market. So if you had followed that fellow's advice to be diversified ex-US, you would be up just 59% versus much, much higher had you been with someone who understands what's going on in the world and invests to try to take advantage of that knowledge. And we'll see another thing we need to be is conventional wisdom is bonds are safe, right? Okay, bonds, but bond funds are not safe. That's my point. A bond is not a bond fund, right? So what's another word for bond? It's another word is fixed income. So, but bond funds, so going back to that example, do I have this example? Let's do an example here. This is US interest rates over time, which is very important to understand the US markets as well as the global markets. It shot up to the high at 16% in what was precipitated in the 1970s. Does anyone know why we had such high inflation and interest rates? So the answer is one, Nixon took us off the gold standard. And so there was huge inflation. As well, in the 1970s, there was the oil crisis. So that created huge inflation, peaked, and Volcker came in and finally tried to crack the back, because we know what happened in Weimar Germany when they had too much inflation. So trying to bring it down. But so going back to 1993, when they did this research, interest rates, and this is the US Treasury, is at 7%. That's a very nice number. So let's just say even if we go to 2008, when it was about 5%. So traditionally, if you look at stock investing investing in America, they say, well, the safe thing is to go with bonds. And traditionally, you bought a bond. You bought a bond, let's say here from the U.S. government for 5%. So as you get older, you should have more bonds. Is traditional theory, because let's say you retired 65 with $1 million. You put it all into bonds. You got 50,000 of income a year, plus you could add it to your Social Security, 30,000. You have 80,000 a year, and in 10 years you could get your money back. That was nice and safe, right? But what's happened over time is it's gone down to 1.5%, because after the crisis they lowered rates to try to stimulate investment, and we're still having trouble getting it higher. So 1.5%. So now the problem is this huge asset class, which is bonds, are no longer serving their purpose of providing nice, safe retirement yield and income for retirees in particular, and this is a problem. So what happened here is the US markets, you'll see interest rates go down and the stock market goes up, because, well, let's say even in 2008, instead of getting 1.5% on a US Treasury, you could buy Apple and get a 2.2% dividend yield. You could get more income and more upside. So basically, there's been huge rotation from the bond money that would have gone into bonds into the equity markets. And that's why we have such huge, that's why we have very high valuations right now. It's called TINA. There is no alternative. And so that's why we have high valuations, because bond yields are so low. This just shows different. So let's just pivot a bit to the world stock markets. So one, as I alluded to before, just because it says there is a difference between the size of the country, the GDP, and how much it's represented in the stock market and the index. As I mentioned, India is lower representation than Alibaba and Tencent as of last year. So that is because the MSCI, the other index makers, they get to do whatever they want and decide which countries should be in it. They added Taiwan and Korea to the emerging market index, even though a lot of us would say, well, Taiwan and certainly Korea, I have an article, is not an emerging market, but they were performing well, so there they added them to it. So we're going to go the US, we see 56% of the size of world stock markets, then Japan, China. This is as of 2021. So China's the second most important after the US. And so we need to understand what's been happening in China. As I mentioned before, in 2001, why did commodity prices why does commodities prices go up so much in the 2000s? Well, there are two reasons. There was one, what happened in 2001 in the US? So we had the dot-com bust and we had 9/11. So interest rates, we wanted to stimulate the economy. They lowered interest rates. And what did people do in America with their money? They started buying housing. That was the start of the housing boom in America. Meanwhile, what happened in China? 2001. They joined the World Trade Organization. So all of a sudden, all the factories started being built in China. So you have all this commodity demand. And as we went back in the 1990s, there was a glut of commodities. Commodities take 7 years or so or 5, depending on the one, to build up a supply. So you have this huge demand in the 2000s in little supply. And that's why commodities did so well. But so China, we need to understand that they have I wanted to find, let's see, the right chart. Any questions while I find the right chart? Anyone? No, okay. I just want to find, let's go back to the 2000s. So here's the 2000s. So here we saw this recession here, right? And then, so the S&P came down, it came up a little bit. Dow Jones, you can see it's coming down, but going up. And so that's when China comes in and commodity demand. We're going to use here the oil price as a proxy for commodity demand back in 2000. So you see it hit a low, China 2001. China joins the WTO, and then look at demand for oil. Look how much the price goes up because the demand's going up. And in 2008, who hosted the Olympics in 2008? China. So if you're planning the biggest party, let's say a wedding, and you want to make sure it's good, do you make sure you have too much alcohol or too little alcohol? Too much. So basically, they stockpiled oil, and you can see we had a crash. And so we had the Lehman crash, and it all came tumbling down. And so what the U.S. did was cash for clunkers and try to stimulate the economy. What they did in China is they said, just as I said, in mutual fund managers, their number one goal is to keep their job. The Chinese leadership, their number one is to keep their job, and that's to keep people employed. So they went on a huge fixed investment spending spree, which was to bring the poor Chinese out of subsistence farming into the cities. And so that then rebuild more commodity demand. Now, just step back here, understanding too about how to think about the world and invest. Going back about my grandfather, he was able to survive because he understands the world, but we'll also think about companies. So I later worked for a company called Rio Tinto, which is the second biggest mining firm in the world. And what had happened is in 2007, they had bought Alcan, the aluminum company of Canada, at the top of the market. The market tanks. They had bought it for debt. They had huge debt payments and they couldn't pay it. And so BHP, which is the biggest mining firm in the world, came along and said, we wanted to buy them. The leadership didn't want that. They got Credit Suisse, they got poison pills, whatever, to make sure they could be a standalone company. It succeeded. But what happened? What happened is they look at their economists and they said, why didn't you tell us not to buy aluminum company of Canada at the top of the market? And the economist said, we're long run economists. The life of a mine is 30. We don't deal with the short run, 0 to 5 years. And so who said the famous statement, in the long run, we're all dead? So basically they said, we need, under Keynes, we need people that understand what is happening in the short run from the 0 to 5 years in the financial markets as well. No longer can we just take a base case, economic base case of the world is growing by 3% a year, China by 6%, but we need to understand the range of scenarios. So for instance, will China go bust? Because we need to be able to be a growing entity no matter what happens. So I was brought on to do that. And some of the things I surfaced about scenarios was in 2011. 2011 was the Arab Spring, right? Yes. 2011, everybody, you can see this commodity demand, all the banks were saying, oh, copper is going to go, there's going to be huge demand. Copper was at 10,000 at the time. And everyone said it's going to 30. Spring is going to make oil price. We've already seen oil price spike. We know the US is a huge importer. It's just changing, but still a big importer. And China is a huge importer of oil. So the two biggest oil countries in the world are going to slow as a result. As well, I was talking to the traders, a trafficker, they said nobody in China is buying. And so it just shows you, going back to conventional wisdom, you don't necessarily listen to Goldman Sachs or Barclays, because the other thing is, the one, they're looking and they hire people that are looking backwards, they're not necessarily intuitive, they can't necessarily add these dots together, connect these dots. And two, they often have incentives, like Barclays was doing the IPO for Glencore. So of course they were going to have a bullish outlook on commodities, because they wanted to get a higher valuation for Glencore. So another, as I was alluding to, we surfaced the fact that Europe was a terrible currency union and it might break up and split apart, which is basically what was going on with Greece and Spain. And so what people don't understand in America is that it's a terrible economic union. So what happened when Greece, let's say, joined together, we'll just say Greece and Germany. What happened is Germany's currency went down by 30% by joining with these weaker countries. So just in that, they're exporting to China, they're exporting industrial goods to the US. That's with that, they're 30% more competitive. So that's why Germany was doing so well. Yes, they're industrious people, but two, their currency was 30% more cheap. What's happening in Greece? Everything's 30% more expensive. It's harder. Don't we all want to go to Greece for vacations? But it's now 30% more expensive. And meanwhile, they have all these issues with immigrants coming into Greece. Germany's not helping. And so I actually had a conversation with David Miliband, who was if anyone knows David Miliband? So he was supposed to be the Labour Party, but I said the problem is we don't have a Hamilton moment in Europe, whereas in the US, I always say, who's the president of Europe? Anyone know? Okay, the president of Europe, I say, is whoever Germany decides it is. There's a technical answer is there's a 6-month rotation. The actual answer is Germany is the biggest country, and but what Germany says goes. So the problem is that in the US, New York and California are huge, but they still have to work with the smaller states and the smaller interests. And that's because we have the Senate, where every state has 2 seats. And that creates compromises between the big states and the small states, and the powerful and the less powerful. And that it does not exist in Europe. And that you can see that's why the UK left. They had no say. So I'm actually pro-Brexit, and I wish the best for the UK, where I'm now a citizen. So that's what, going back, not investing in Europe. And that's why just going back companies, we need to think about the worst case scenarios and how the world will affect us. So we'll move, we've gone through most of it. We're going to click back. Going bond funds don't make sense. I had this article in the Wall Street Journal. As I said, the companies, financial firms, they did an equity ETF. So they said, let's do a bond ETF. A bond ETF makes no sense. Fixed income, it's not fixed income. And as interest rates rise, then bond funds are more likely to lose your money. It's not a safe investment. So we'll wrap it up here. So just going back to China. So China is now, as I say, another huge transition point. Here's the Arab Spring, as I said, where it's a huge five-year plan. China's at a huge transition right now as far as strategic priorities. I do believe that we're going into a resource war with China. We can already see that over natural gas and rare earths and things like that. So China's number one goal with there's national security concerns. And so what happened is their fertility rate is super low. And what happened to Japan when its fertility rate was super low? Japan was at the top of the world, but they couldn't grow. And then you have an aging population and you have no young people to work and pay for the Social Security version. So that's the problem in China, is they don't have a high fertility rate. Now, we don't have a high fertility rate in the US either, but we are much happier to have immigrants to come, and immigrants are much happier to come here to fill our labor force demands. But so China, regulatory crackdown, saying we need to get our fertility rate up. So what are the problems with people starting families? Well, they can't afford any of the real estate. We can see there's an issue with Evergrande. Meanwhile, they can't afford, they crack down on the education companies because it was so expensive to educate children because they were taking the best teachers away from the public schools. So I said I issued a newsletter in last August. I said, get out of China. Their focus is not economic growth anymore. It's national security, as they say, common prosperity, getting the middle class up for also because they're going to need a military force, a labor force, everything else, and that's their priority. So we're going to go. So the U.S., there's still lots of exposure. I've touched on this fact that you need to understand what is the sector allocation. So for instance, in Europe, they have no technology. Why I wouldn't invest in Europe for one reason or have much. We're having this resource conflict here growing. And just going back to this thing of don't believe the labels of ESG. They claim that they're socially responsible now. They just slap on a label because they can make money and say, what's really in a socially responsible fund? A lot of people, I want to invest in socially responsible fund, ESG. And so they invest in that. What are they investing in? What's the most sustainable companies according to the ESG indexes? Microsoft, Apple, Amazon. Those, according to the indexes, are what are ESG. And I think we all can agree for a number of reasons why these are not the most sustainable, ethical companies in America. But basically what they did, they just took out the oil companies, they took out the prison companies and kept it as is. So that's why I say it's better to invest strategically in companies that you believe in. You understand what are their issues. I mean, Amazon they came out about the issues about workplace. So if you really do care, then it's better to have a portfolio where you actually know what companies you're investing in and you support their labor practices or whatever issue you might care about. So as some takeaways, Their myths are common wisdom. Diversification outperforms. My view is most investors are over diversified in these black holes. It's better you want to be diversified, but 70 stocks, not 700, which is if you have a bunch of funds, that's how you invested. You can't pick the market. Well, tell that to people that invest into Apple in the 1990s. There's mean reversion. Value stocks have not come back for the last decade. We're still in a technological revolution, so I believe value growth will continue. There's no reason that we should have mean reversion. Managers are best in class, the fund managers. I say no, there's the lack of diversity for one, as well as what we said about the people that they choose, even within, are all of the same. If you guys know Myers-Briggs, at STJ instead of say NTP or EN. So they're a small slice of the world, and that doesn't just because they can't outperform the market doesn't mean nobody can. And bond funds do not give safe, reliable returns, and be wary, especially as interest rates go up. All right, so that's it. Thank you for hanging in. I hope you learned something. I am available for questions for those that have been able to stick it through. It's late, I know, and people have plans, so I understand too that there are things that people have plans for, and I hope you learned something, enjoyed the talk today. And always available to talk offline, offline to those, that call part of it or have some questions. Okay. Frank, did you have anything you want to say?
No, just wanted to show you my face and say thank you. That's it.
Thank you. All right. Thank you, Norman, for being my most active participant. You scared everyone off. You kept getting all their answers right. You were at 300 right at the start there. So, you scared off all the other contestants.
What about Einstein's bed?
Oh, there you go. Einstein's bed. Good one. Oh. So it was funny. Well, I was thinking about, Thursday Renaissance weekend, I did a comedy show for Dr. Ruth. Remember Dr. Ruth? She's still alive and kicking, so she's 91. And I said, she sounds like my Austrian grandmother. But I was thinking to myself, how do I know what my Austrian grandmother sounds like? Because my Austrian grandmother died when my dad was 6. I never met her. So the reason is because her cousin from Austria emigrated to the UK, and she married a man named Peter Plesch, who was a polymer specialist, a professor in chemistry, and he had emigrated from Berlin. And his father, Janos Plesch, was Einstein's doctor and good friend in Berlin. So when Einstein came to Berlin, they would stay with him. And so Peter had, Einstein's bed in his house in the UK. And so when I would go there, especially when I want to do well in my physics exams, I would sleep in the Einstein's bed. That's the story. Great. Well, thank you very much. Norman in particular, you've been great. Todd, thank you so much for putting this together. I hope future people can hear this. I know the time, it's hard at 6 to 7-ish in the evening when everyone's Zoom fatigued. So appreciate everyone who might also look at this remotely. And I'm here, Maya MetaPoint Advisors, or mmjoelson@gmail.com if you want to contact me directly. Thank you.
Thank you, Maya. It's been a pleasure, and I enjoyed your presentation, and I can tell you put a lot of work into your slides, so you get a gold star for that.
Great.
I see Karen's joined us. Karen, we can't hear you. Do you want to say goodbye to Maya?
Sure.
And Karen, I love you. As I said, the background. You have amazing archaeology. You have to tell us what's behind you. I'm particularly interested in what's on the shelf there. Those characters.
Maya, I'm a Hispanist. This
Okay.
is my